Hey there, crypto enthusiasts. Welcome back to our channel. If you're new here, don't forget to hit that subscribe button and ring the bell so you never miss out on the latest in cryptocurrency, blockchain, and the world of decentralized finance. Today we're diving deep into the exhilarating and sometimes turbulent world of cryptocurrency trading. Cryptocurrency trading has taken the financial world by storm over the past decade. Whether you're looking to dip your toes in the water or become a full-fledged day trader, understanding the ins and outs of crypto trading is crucial for navigating this volatile market. So, grab a cup of coffee, settle in, and let's embark on this journey together. We'll cover everything from the basics to advanced trading strategies, risk management, and the tools you'll need to succeed. Ready? Let's get started. First things first. Let's get the basics down. Cryptocurrency trading involves buying and selling digital currencies with the aim of making a profit. Unlike traditional stock markets, the crypto market operates 24/7, offering endless opportunities, but also constant risk. There are two main types of exchanges you'll encounter: centralized exchanges, CEX, and decentralized exchanges, DEX. Centralized exchanges, like Binance and Kraken, are managed by a company that acts as an intermediary between buyers and sellers. They offer high liquidity, advanced trading tools, and customer support. On the other hand, decentralized exchanges, such as Uniswap and SushiSwap, operate without intermediaries, allowing for peer-to-peer trading directly from your crypto wallet. Next, we need to understand the different types of trading pairs. In crypto trading, you often see pairs like BTC, USD, or AUD, BTC. The first currency in the pair is the base currency, and the second is the quote currency. When you see BTC, USD at a price of $30,000, it means one Bitcoin is worth $30,000. Understanding candlestick charts is also crucial. These charts display the high, low, open, and close prices for a given period, providing insights into market sentiment. Green or white candlesticks indicate rising prices, while red or black candlesticks indicate falling prices. Patterns like dojis, hammers, and engulfing patterns can signal potential market reversals or continuations. Now let's move on to developing a trading strategy. Creating a solid trading strategy is essential for success in the cryptocurrency market. A strategy helps you make informed decisions and manage your emotions during volatile market movements. This requires a good understanding of technical analysis, market trends, and quick decision-making skills. Swing trading is another strategy, where traders hold positions for several days or weeks to capitalize on medium-term price trends. Position trading, or trend trading, involves holding positions for months or even years to benefit from long-term trends. This is less stressful and time-consuming, but requires patience and a long-term vision. Psychology plays a huge role in trading success. Emotions like fear, greed, and impatience can cloud your judgment and lead to impulsive decisions. Develop a trading plan and stick to it, regardless of market conditions. This discipline will help you stay focused and make rational decisions. Now, let's dive into technical analysis. Technical analysis involves studying historical price and volume data to forecast future price movements. While it may seem complex at first, mastering a few key concepts can greatly improve your trading performance. Trend lines are the foundation of technical analysis. An uptrend is characterized by higher highs and higher lows, while a downtrend shows lower highs and lower lows. Drawing trend lines helps you identify these patterns and make informed trading decisions. Support and resistance levels are critical. Support is a price level where buying pressure outweighs selling pressure, preventing the price from falling further. Moving averages smooth out price data to help identify trends. The two most common types are the simple moving average, SMA, and the exponential moving average, EMA. SMAs give equal weight to all data points, while EMAs give more weight to recent data, making them more responsive to price changes. Crossovers between short-term and long-term moving averages can signal potential buy or sell opportunities. Indicators like the Relative Strength Index, RSI, and Moving Average Convergence Divergence, MACD, provide additional insights. The RSI measures the speed and change of price movements, helping identify overbought or oversold conditions. The MACD uses moving averages to identify changes in momentum, signaling potential trend reversals. If you found this video helpful, please give it a thumbs up. Also, we love hearing from you. So drop a comment below with your thoughts, questions, or any topics you'd like us to cover in future videos. And most importantly, don't forget to subscribe to our channel and hit that bell icon so you never miss out on our latest videos. We're here to help you navigate the exciting world of cryptocurrency and blockchain technology. Thanks for watching. And until next time, happy trading.